Hello to Mark Hall here with your weekly fine wine investment market update. Today, Thursday, the 23rd of January, 2014. So, to start with a quick overview of the news. Well, the LiveX 50, the first growth index, actually showed a slight uptick in prices over the past week, but this was quickly halted by lower bids being accepted for these wines on the exchange. We now have the market entering the new on-premier season, so we'll start to see which way the buyers are looking to go. Last year it was the first growth with back vintages being purchased, and that of course pushed the LiveX 50 forward. But this rise in value was totally unsustainable, and buyers ducked for cover over certain 2012 release prices being too high. Will this year be the same, is the question on everybody's lips. Well, it's clear that if the first growths want to see sustainable growth again, then the Chateau have to release at better prices, but only time will tell on that one. An important addition to LiveX has been released as they launched their new index last week, the LiveX 1000 index. Now, this index has been created to reflect the changing shape of the market by covering more regions. It actually comprised of several sub-indices: the Bordeaux 500, the Bordeaux Legends 50, the Burgundy 150, the Champagne 50, Rhone 100, Italy 100, and finally the rest of the world 50. And we feel this index truly reflects the global opportunities that are available to investors in today's marketplace. So to other news, Tim Aitken, he published his 2014 wine wish list this week, and he mentions one of his wishes is that wine companies should stop treating China as the answer to all their woes. And we think they're looking at China from an investment perspective. Their buying patterns in wine have in fact broadened significantly, which is reflected by the decline in first growth prices. There's a new acronym on the block, and that is MINTS, standing for Mexico, Indonesia, Nigeria, and Turkey. Now, these emerging markets could potentially be new growth areas for suppliers of wine, but we would stress that an investor should think carefully, as they are not developed as yet, and in our opinion, will not show viable growth for a number of years. So if anyone is offering you quick returns on the basis of mints, well, we would suggest that you actually err on the side of caution. Finally, we'd like to talk to you about a wine to potentially add to your watch list, and that is the Lascaux 2011. Now, the Chateau has often been described as one of the more international estates. Its confidence and innovation has been firmly backed since Colony Capital, an American investment house, took over in 2001. It is reported that they spent $67 million on the purchase and a further $47 million on renovations and investments. These actually included full geological study and replanting programs. The Chateau was then taken over by a French insurance company for a buyout of $270 million. Now, it sells 90% of its production en primeur, has a slow but steady growth market, and over the past 5 years, the 2005 is up by 27.5%, the 2004 is up by 23.5%, and the 2000 is up by 69.8%. Now, most of the vintages actually trade within the £450 to £700 price range per case, and the 2011 can be currently purchased for around £380 per case. So this means a 20% gain could be achieved by the wine rising to just £456. So that's it for this week, and I will see you next Thursday.